You've seen the headlines, right? That little voice in your head, the fear of missing out, gets a little louder every time Bitcoin hits a new high. Your friends are talking about it. You see the stories of people making fortunes, and you get that powerful urge to just jump in, to not get left behind. But here's the thing, acting on that hype is a trap. It's the number one way people lose their shirts in this market, buying at the peak of the frenzy, panicking when it dips, and selling at the bottom. That isn't investing, it's gambling with your future. One wrong move, and that dream of a big win can vanish. The line between a life-changing investment and a devastating loss is drawn with one simple thing: knowledge. That's why we're going to break down the 5 things you absolutely have to understand before you even think about putting a single dollar into Bitcoin. Getting a handle on these concepts will give you the confidence to invest smartly and separate you from the gamblers who inevitably get wrecked. This isn't about hype. It's about being prepared. Let's get into it. Before we start, I have to say this. The content here is for educational purposes only and is not financial advice. The crypto market is incredibly volatile. Always do your own research, and please consider talking to a professional financial advisor before making any moves. A classic mistake is investing more than you can truly afford to lose. Let's make sure you avoid that. First up, and this is non-negotiable, you have to understand the engine that makes Bitcoin run, the blockchain. Buying Bitcoin without knowing what blockchain is, that's like buying a car without knowing what an engine does. You don't need to be a mechanic, but you do need to get the basics that give it value. Let's start with the big one, decentralization. Your bank is a company. It controls your money and all the records. Bitcoin is the opposite. It runs on a decentralized network of thousands of computers called nodes all over the world. No single person, company, or government is in charge. This is the core idea. For an investor, it means your asset isn't at the mercy of a CEO's bad decision or a country's political drama. It's a global borderless system. Next is immutability. It's a fancy word, but it just means that once a transaction is on the Bitcoin blockchain, it's locked in forever. It can't be changed, reversed, or deleted. This creates an insane level of security and trust because, you know, the history of transactions is real and tamper-proof. But it's a double-edged sword. If you send your Bitcoin to the wrong address, that's it. There's no customer service hotline. There are no takebacks. The transaction is final, which puts all the responsibility squarely on your shoulders. So how does the network agree on anything without a boss? Now, that's where consensus mechanisms come in. Bitcoin uses something called proof of work, POW. In simple terms, miners use powerful computers to solve incredibly difficult math puzzles. The first one to find the solution gets to add the next block of transactions to the chain and earns a reward of brand new Bitcoin. This whole process is what keeps the network secure and is how new coins are created. It's also famously energy intensive. As of early 2025, the Cambridge Center for Alternative Finance estimated Bitcoin's annual electricity consumption at 138 terawatt hours. However, the energy mix is shifting. A 2025 CCAF report noted that sustainable energy sources, including renewables and nuclear, now account for about 52.4% of mining power, with coal use dropping significantly. Understanding this helps you appreciate both the security and the environmental debates around Bitcoin. Finally, you need to know the difference between coins and tokens. Bitcoin is a coin. It's the native asset of its very own blockchain. Its whole purpose is to be digital money and a store of value. Tokens, on the other hand, are built on top of other blockchains like Ethereum. Think of Ethereum as a global computer, and tokens are the apps that run on it. This difference is everything. The reason to invest in a coin like Bitcoin is totally different from the reason to invest in a token, which might represent a piece of a project or a key to an application. Bitcoin's value is tied to being the original, most secure, and most decentralized blockchain out there. If you don't get these ideas, you're just betting on a number going up. Once you get them, you can start to understand why it might go up, and that's when you can make a real investment decision. First up, and this is non-negotiable, you have to understand the engine that makes Bitcoin run, the blockchain. Buying Bitcoin without knowing what blockchain is, that's like buying a car without knowing what an engine does. You don't need to be a mechanic, but you do need to get the basics that give it value. Let's start with the big one, decentralization. Your bank is a company. It controls your money and all the records. Bitcoin is the opposite. It runs on a decentralized network of thousands of computers called nodes all over the world. No single person, company, or government is in charge. This is the core idea. For an investor, it means your asset isn't at the mercy of a CEO's bad decision or a country's political drama. It's a global, borderless system. Next is immutability. It's a fancy word, but it just means that once a transaction is on the Bitcoin blockchain, it's locked in forever. It can't be changed, reversed, or deleted. This creates an insane level of security and trust because you know the history of transactions is real and tamper-proof, but it's a double-edged sword. If you send your Bitcoin to the wrong address, that's it. There's no customer service hotline. There are no takebacks. The transaction is final, which puts all the responsibility squarely on your shoulders. So how does the network agree on anything without a boss? That's where consensus mechanisms come in. Bitcoin uses something called proof of work, POW. In simple terms, miners use powerful computers to solve incredibly difficult math puzzles. The first one to find the solution gets to add the next block of transactions to the chain and earns a reward of brand new Bitcoin. This whole process is what keeps the network secure and is how new coins are created. It's also famously energy intensive. As of early 2025, the Cambridge Center for Alternative Finance estimated Bitcoin's annual electricity consumption at 138 terawatt hours. However, the energy mix is shifting. A 2025 CCAF report noted that sustainable energy sources, including renewables and nuclear, now account for about 52.4% of mining power, with coal use dropping significantly. Understanding this helps you appreciate both the security and the environmental debates around Bitcoin. Finally, you need to know the difference between coins and tokens. Bitcoin is a coin. It's the native asset of its very own blockchain. Its whole purpose is to be digital money and a store of value. Tokens, on the other hand, are built on top of other blockchains like Ethereum. Think of Ethereum as a global computer, and tokens are the apps that run on it. This difference is everything. The reason to invest in a coin like Bitcoin is totally different from the reason to invest in a token, which might represent a piece of a project or a key to an application. Bitcoin's value is tied to being the original, most secure, and most decentralized blockchain out there. If you don't get these ideas, you're just betting on a number going up. Once you get them, you can start to understand why it might go up, and that's when you can make a real investment decision. The second thing to get a handle on is fundamental analysis. In stocks, this means you look at a company's revenue, profits, and leadership to figure out what it's really worth. Bitcoin doesn't have a CEO or profits, so the method is different, but the goal is the same. You have to look past the daily price swings and analyze the actual health and adoption of the network. Just chasing green candles on a chart is how you end up buying high and selling low. So where do you even start? First, the white paper. The Bitcoin white paper, written in 2008 by the mysterious Satoshi Nakamoto, is the birth certificate of this entire industry. It lays out the why behind it all, the goals, the tech, and the vision. Reading it helps you understand what problem Bitcoin was built to solve, a peer-to-peer electronic cash system. For any crypto project, the white paper is your first stop. It's where you find out if it's a serious project or just a bunch of marketing buzzwords. Next, while other projects have a team and governance structure you can analyze, Bitcoin is the odd one out. It has no CEO and no marketing team. Development is handled by a decentralized group of open source developers. This is actually one of its biggest strengths. It makes the network incredibly resilient. It can't be easily censored or taken over by a single entity. Progress is slow and careful, which might seem frustrating, but for something aiming to be a global store of value, prioritizing security and stability is exactly what you want. A huge part of Bitcoin's fundamental analysis is digging into on-chain data. Because the blockchain is a public ledger, you have a transparent look at the network's vital signs. Key metrics to watch are active addresses. How many unique addresses are actually using Bitcoin? If this number is going up over time, it's a great sign of growing adoption and a healthy network. Transaction volume and fees. How much value is actually moving on the network, and are people willing to pay fees for it? High volume and consistent fees show that it has real utility. Hash rate. This is the total computing power miners are using to secure the network. A high and rising hash rate means the network is extremely secure, and miners are confident enough in Bitcoin's future to invest serious resources. These metrics are like a real-time health report for the network, a world away from the noise and hype on social media. Finally, think about the use case and market fit. Bitcoin really has two main stories. The first is digital gold. It's a scarce, durable, and portable store of value that can protect against inflation and shaky currencies. Its supply is hard-capped at 21 million coins, making it provably finite in a way government money can never be. The second story is as a global censorship-resistant payment network. Now it's too slow and energy-intensive for buying coffee. One transaction can consume as much power as a U.S. household uses in over 40 days. But its ability to settle huge amounts of value across borders without a bank or government in the middle is unmatched. Some studies have noted its climate damage per dollar of value created is significantly higher than that of mining real gold. Understanding which narrative you believe in, digital gold or global settlement layer, is the core of your investment thesis. By learning to look at these fundamentals, you stop being a speculator and start being an investor. You'll build your conviction on data, not just headlines. The third thing you can't ignore is market conditions. The crypto market is famous for its volatility, moving in big, dramatic cycles of boom and bust. Ignoring these cycles is like trying to sail across the ocean without ever checking the weather. You might get lucky, but you're probably going to get caught in a nasty storm. Crypto market cycles have historically played out over about 4 years, often driven by the Bitcoin halving. This is a built-in event that happens every 4 years and cuts the reward for miners in half, effectively squeezing the new supply of Bitcoin. The last halving was in April 2024. Historically, this supply shock has been a major catalyst for bull runs, though the cycle following the 2024 halving has shown weaker performance compared to previous ones. As of late 2025, the market has seen significant price action, with some analysts suggesting the cycle peak is near, while others eye targets of $200,000. Understanding this cyclical nature is crucial. The most common and painful mistake beginners make is FOMOing in at the euphoric peak of a bull market. Learning to spot the different phases, accumulation, bull run, euphoria, and correction is how you can time your entries and exits a little better. Next, you absolutely must pay attention to the regulatory landscape. For a long time, governments mostly ignored crypto. Those days are over. In 2025, regulation is one of the biggest stories. The European Union's Comprehensive Markets and Crypto Assets, MiCA framework, is now fully in effect as of December 2024, creating a harmonized set of rules across the EU. In the United States, after years of uncertainty, we saw the first major federal crypto legislation with the Genius Act, which created a regulatory framework for stablecoins in July 2025. These developments, along with jurisdictions like Hong Kong and Dubai trying to become crypto hubs, show that the industry is maturing. Good regulation can build confidence and drive adoption, while threats of a crackdown can spark fear and sell-offs. Staying on top of this is no longer optional. It's essential risk management. Another massive trend is institutional adoption. For years, Bitcoin was just for individuals and tech lovers. That has completely changed. The approval of spot Bitcoin ETFs in the US was a game changer, opening the floodgates for big money. Now we're seeing major asset managers and even corporate treasuries adding Bitcoin to their portfolios as a legitimate asset. This flood of institutional capital creates a new source of demand and might help reduce some of the wild volatility we saw in past cycles. Watching where the big money is going can be a powerful clue about the market's long-term direction. Finally, keep an eye on technological innovations. The crypto space never stops moving. Some key things to watch are Layer 2 scaling solutions. For Bitcoin, this is the Lightning Network. For other platforms like Ethereum, it's rollups. These are technologies built on top of the main blockchain to make transactions faster and way cheaper. They're critical for crypto to ever be used by billions of people. AI integration, the collision of AI and blockchain, is a huge new narrative. Projects are exploring everything from decentralized AI computing to using AI to analyze blockchain data. Tokenization. This is the idea of putting real-world assets like real estate, art, or stocks onto the blockchain. It has the potential to unlock trillions of dollars in value and is a space to watch closely. By understanding these big picture forces, the market cycle, regulations, institutional money, and tech, you can start making strategic moves instead of just reacting to the latest price alert. Hey, if you're getting some real value out of this and you want to keep learning how to invest in crypto the smart way, do me a quick favor and hit that like button and subscribe to the channel. It really helps us out, and make sure you don't miss what's coming next. Now let's get into our fourth point, which is all about making sense of the data. The fourth thing you need to learn is how to analyze market data. If fundamental analysis tells you what to buy, market data can help you figure out when to buy or sell. A lot of beginners either ignore this stuff completely or get tangled up in 100 different confusing indicators. The trick is to focus on a few key ideas that cut through the noise. The first and most important metric isn't price, it's market capitalization, market cap. This is a classic rookie mistake, thinking a coin is cheap just because its price per coin is low. That's totally misleading. Market cap is the coin's price multiplied by its circulating supply, giving you the total value of the entire network. A $1 coin with 100 billion in circulation has the same $100 billion market cap as a $50,000 coin with only 2 million in circulation. Market cap tells you how big and established a project is. Bitcoin has the largest market cap, making it the anchor of the whole crypto world. Always start with market cap to get a sense of a project's true size. Next, you need a basic grasp of price charts and technical indicators. You don't need to become a day trader, but you should know how to read a simple candlestick chart. Each candle shows you the open, high, low, and closing price for a period, visualizing the fight between buyers and sellers. You should also get familiar with two simple concepts: support and resistance. Support is a price level where buying pressure tends to show up and stop a downtrend. Resistance is the opposite, a ceiling where selling pressure often kicks in. Identifying these zones can help you make smarter entries and exits instead of just guessing. Moving averages. A moving average smooths out the price action into a single line, making it easier to see the trend. A popular strategy is to check if the price is above a long-term moving average, like the 200-day, which often signals a healthy long-term uptrend. Another piece of data you can't ignore is trading volume. Volume is the total amount of an asset traded in a given period. Think of it as a measure of conviction. A price move up or down on high volume is much more significant than a move on low volume. If Bitcoin breaks a key resistance level on huge volume, it signals strong belief from buyers. If it breaks out on weak volume, it could be a fake out, a trap for eager buyers. Finally, learn to get a read on sentiment analysis. This is all about the overall mood of the market. Are investors fearful, greedy, or just neutral? Extreme greed, where everyone on social media is talking about easy money and moonshots, is often a huge warning sign that the market is overheated and due for a fall. On the flip side, extreme fear, where everyone is predicting a total collapse, can sometimes be a great buying opportunity for those with a long-term view. Tools like the Crypto Fear and Greed Index try to measure this mood. It's not a crystal ball, but it's a great gut check against your own emotions, helping you avoid buying the hype or panic selling the fear. Getting a handle on these four things, market cap, basic charts, volume, and sentiment, will give you a powerful edge and help you make decisions based on data, not emotion. The fifth and final piece of the puzzle is security and risk management. Making a profit is a thrill, but it's all for nothing if you lose it to a hack or a scam. In crypto, you are your own bank. That means you and only you are responsible for keeping your assets safe. This is not the part to gloss over. First things first, wallet security. Where you store your crypto is the most important security decision you will ever make. There are two main kinds: hot wallets, software wallets. These are apps on your phone or computer or the wallet on a crypto exchange. They're hot because they're always connected to the internet. They're convenient for trading, but they're also way more vulnerable to hacks. Leaving a large amount of crypto on an exchange is a huge risk. If the exchange goes down or gets hacked, your funds can disappear. Remember the saying, not your keys, not your coins. Cold wallets, hardware wallets, these are physical devices like a USB drive that store your private keys completely offline. To send a transaction, you have to physically connect the device and approve it. This makes it almost impossible for a hacker to get your funds remotely. If you're planning to hold crypto for the long term, a good hardware wallet isn't just a good idea, it's essential. When you set up any wallet, you'll get a seed phrase or recovery phrase, usually 12 or 24 words, and this phrase is the master key to all of your crypto. Anyone who gets it can steal everything. You must write it down and store it somewhere safe and offline. Never ever store it on your computer, in your email, or as a picture on your phone. If you lose your wallet or your computer dies, this phrase is the only way you'll ever get your assets back. Beyond wallets, you need to be on high alert for market risks and scams. The crypto world is full of people trying to trick you out of your money. And in 2025, the scams are getting smarter with tools like AI and deep fakes. Watch out for phishing scams, fake emails, social media DMs, and websites that look real trying to trick you into giving up your private keys or passwords. Always double check URLs and be deeply suspicious of any unsolicited message. Rug pulls. A new project gets a ton of hype, people pile in, and then the developers vanish with all the money, leaving everyone with a worthless token. Always research the team behind a project. Pump and dump schemes. Scammers coordinate to buy a worthless coin, hype it up all over social media to create FOMO, and then dump all their holdings on the new buyers, crashing the price to zero. Giveaway scams. Someone pretending to be a famous influencer or exchange promises to send you double the crypto you send them. Legitimate giveaways will never ask you to send them money first. The only defense against this is due diligence. It's on you to do your own research. DYOR. Before you use an exchange, check its security history. Before you invest in a project, read the white paper, look into the team, and see if there's a real community behind it. Be skeptical. If something sounds too good to be true, like a promise of guaranteed high returns, it is almost always a scam. By making security a priority, you build a fortress around your investment. This is the final step that separates a responsible investor from someone just waiting to become a horror story. Summary and conclusion. All right, let's do a quick recap of the 5 things you need to get right before you touch Bitcoin. Understand the core technology, get a handle on decentralization, immutability, and proof of work so you know where Bitcoin's value comes from. Do your fundamental analysis, look past the price, use on-chain data like active addresses and hash rate to see how healthy the network actually is, read the market conditions, know the 4-year cycles, keep up with regulation, and follow the institutional money to see the big picture. Analyze the market data. Use market cap, basic charts, volume, and sentiment to figure out when to make your moves. Master security and risk management. Get a hardware wallet. Guard your seed phrase like your life depends on it, and learn to spot the scams. Jumping into Bitcoin without this knowledge is like walking into a minefield with a blindfold on. The headlines and the hype will always be there, trying to trigger your fear of missing out. But now you have a framework, you have a map. The journey into crypto is a marathon, not a sprint. It rewards patience, continuous learning, and discipline. Once you master these 5 areas, you're not just gambling on hype anymore. You're making calculated decisions based on technology, data, and a clear-eyed view of the risks. You are investing. Thanks so much for watching. If this guide helped you out, please subscribe to the channel and hit the notification bell so you don't miss our next video. We're all about giving you clear, no-hype crypto education, and drop a comment below. Which of these 5 points was the biggest eye-opener for you? I read all the comments and I'd love to hear your thoughts. Until next time, invest safely.